Hello, another day in the life of an insurance agent. My name is David Matkoski, and our agency is called Vistaplan Financial Group. Today I'm meeting with a couple of medical doctors. We're going to be talking about disability insurance. And so today's topic is disability insurance, options and features. Okay, so let's get started. Let's talk about disability insurance. I've broken this down into three different sections. We're first going to look at the basic definitions in a disability insurance contract. Those basic definitions include an elimination period, a benefit period, and whether or not the premiums are guaranteed in a contract. So let's review these quickly. Elimination period. Elimination period is the number of days that you wait before any disability benefits are payable. That means that it's like a deductible. So if you become disabled, if your elimination period is 30 days, the first 30 days you're not eligible for any benefits. So you're not eligible for any benefits until after the elimination period. Most elimination periods in disability contracts are 30 days, 60 days, 90 days, or 120 days. The two most popular are 60 and 90. The reason for that is the longer the elimination period, the lower the premium. When you go down to a 30-day elimination period, the premiums increase quite substantially. With a longer elimination period, if you go beyond 90 days, chances are you don't save very much. The reason is insurance companies have stats that show that if you're disabled 90 days, a male age 42 will be disabled 5.2 years. Therefore, having a longer elimination period than 90 days doesn't save you much money. So the two most popular elimination periods are 30 days and 60 days. And the most expensive is 30 days. Now, there are some contracts with some companies where the 30-day is very feasible if you take a shorter benefit period. But today we're going to primarily be talking about a professional contract. So most popular, 60 days and 90 days. The second basic definition or feature in a disability insurance contract is the benefit period. Most benefit periods are payable to age 65. That means if you should become disabled and remain so disabled, you would receive benefits all the way through till age 65. There are some options in some contracts where you could get extended benefits beyond age 65 if the right thing happens to you. Many times you could also buy shorter benefit periods, 5-year benefit periods, some contracts 10-year benefit periods, but the most popular is benefits paid to age 65. Then the third basic definition or feature you should know in a disability insurance contract is, are the premiums guaranteed to 65? What you want to know is that, and one of the features of disability insurance is when you buy the contract, the premiums remain level all the way through to 65. So over the years, as your income goes up, your disability premiums look smaller and smaller. So again, the basic definitions in a disability insurance contract are benefit period, elimination period, and whether or not the premiums are guaranteed. They look like this. All right, let's go a little deeper. Let's look at some of the definitions inside the disability insurance contract. You'll notice with most disability insurance contracts, at the very top of every page, of the main front page, it's going to say disability insurance benefits payable to 65. But that doesn't really tell you how long the benefits are going to be paid, because inside a disability insurance contract, you have to go deeper and you actually have to find what the definition for disability insurance actually is. the paragraph usually starts with disability insurance means. And it's really important in a disability insurance contract to find that section and actually learn and understand what your definition actually means in your contract, because at the time of claim, the insurance companies are going to use these definitions to determine whether or not you're eligible for benefits. The second main option or definition inside a disability insurance contract is the residual disability definition. Residual disability means that you've become disabled, you're now returning to work, or maybe you were disabled very severely and you're only able to work part-time. So you're either working, doing all your duties for less time, or there's some specific duties you can't do at all. And residual disability is more important than total disability. There are more people that have to reduce their workload than there are people that have to completely stop and quit working. All kinds of things, and it's mainly extracurricular things that might disable you. A skiing accident, something happens around the house that you disable yourself or become ill. And anyway, knowing what the residual disability definition is very important. The third definition you should understand is partial disability. Partial disability is similar to residual disability with less restrictions. Usually residual or partial disability simply pays a flat benefit of 50% of your benefit for a period of 6 months. That's very typical in disability insurance contracts. Many times with partial disability, you're allowed to change to residual disability at some point in your contract, but once you make that shift, you can't come back to partial disability. But it's important to understand what your total disability benefit is, what your residual definitions are, and what your partial disability definitions mean. These are the three definitions, and this is how they look. All right, last, let's take a look at some of the options available in disability insurance contracts. One of the options available to professionals in disability insurance contracts is something called own occupation. Own occupation means that you become disabled, you're not able to do the duties of your specialty, and you choose a different occupation. You would still continue to receive total disability benefits all the way through till age 65. The second one is cost of living. If you're around 30 years old or younger, or even up to age 40, cost of living is very important, because if you were disabled for a long period of time, inflation slowly erodes your benefits. Having cost of living, your benefits are kept up based on the Consumer Price Index. This third option is, in my mind, the most important. It's called guaranteed insurability option. So let's say you buy a contract with a monthly benefit of $5,000 a month if you were totally disabled. What guaranteed insurability option means is it usually allows you to buy additional monthly benefits in the future non-medically. So there might be a $5,000 total disability benefit in your contract and maybe $10,000 of guaranteed insurability in your contract. That means in the future, without ever having a medical, you could increase your disability benefit based on the option given to you in the contract to allow you to buy additional coverage even if your health's not 100% anymore. Let me give you an example. You go skiing, you wreck your knees, you have knee surgery, your knees are always bothering you. If you decide to buy disability insurance after that, your knees will either be excluded or you're completely going to be declined. If you have a guaranteed insurability option, you could increase your disability insurance, not have to answer any questions about your knees, and you would receive those benefits should something happen to your health and you become disabled. These next two are less important. One's called Pension Guard. Pension Guard simply means that you buy a $5,000 a month benefit for total disability. You buy a $1,500 a month Pension Guard option. So if you're totally disabled, you would receive $5,000 a month, and $1,500 a month would be set aside for your RSP and your savings so that your retirement savings continue to grow. And then the last one is a refund of premium. It's available with a couple companies now where the way it works is you pay premiums for 8 years, or in some cases 10 years, and then you get 50% of the premiums back at the end of that period if you had no claims. So for example, you pay premiums for 8 years. At the end of 8 years, you get 4 years of premiums back that will you can actually take the check, or it can be used to pay the next 4 years of premiums. And then you pay 4 more years of premiums and you get another refund. And again, you always have to remember these refunds are available to you as long as you haven't suffered a disability. So it's always important to know how much can you claim before you lose your refund. So again, the typical options in a disability insurance contract are own occupation, cost of living, guaranteed insurability, pension guard, and premium refund rider. They look something like this. All right, so that's disability insurance. In my mind, disability insurance is the most important contract you could have. But what's even more important is that you understand how the claims are going to work. And the claims are going to be assessed based on the definitions in your contract. So just because the top of your contract says disability insurance paid to age 65, don't take that as necessarily the way it is. You have to dig into your contract, take a look at what you have, and learn what those definitions mean. If you're dealing with us, we'll help you understand those definitions and choose the options that are best for you. So thanks a lot for listening. I hope this has given you some idea about disability insurance features and options. In a minute, you're going to see a slide with our contact information if you want to reach out to us. Subscribe to our YouTube channel. We try to put something up every Wednesday. And anyway, thanks for listening. Hope this has been helpful. Bye-bye.